Welcome back. Molly and I are here to highlight some of the important numbers here for 2025, but also some considerations and action items you want to be looking at before the deadlines here. We got this first slide that really highlights some of the key numbers here that also have deadlines, most of them for 2025. Something we want to make sure is you're filling up each of these buckets if they pertain, specifically to you. Whether it's making sure you're maxing out your 401ks, your health savings accounts, or even you're thinking about your annual gifting to your loved ones or children as well.
Starting with year-end planning and retirement contributions specifically, we want to ensure that you're maxing out your 401k or 403b or other retirement savings options. The employee contribution limit is $23,500. If you're over the age of 50, you get an extra bump in savings with an additional $7,500. There's a unique provision this year. If you're between the ages of 60 and 63, you can contribute an additional $3,750. So best way to double check that is to look at your pay stub and see if you're hitting those totals, or at least with the contributions that you have left remaining between now and the end of the year, that it will help you to fully max out.
And I always like to point out, especially with that magical age of 50, that even if you're turning age 50 coming up here in the middle of December, you still have this calendar year and all of this calendar year to accomplish those contributions. So make sure you're trying to accelerate that if you were waiting to that point. Make sure you hit that deadline by 12/31. The other item too, just to focus on, it's not on here, if you do have the after-tax contribution, which we talk to a lot of clients about, which are contributions above and beyond these limits that we're highlighting here. Reach out to us and we can talk about strategies there, but the opportunity is maybe even to convert those after-tax dollars to the Roth 401k.
Yeah, especially with bonuses, just something to think about if those are hitting before 12/31. IRAs and HSAs, those have individual contribution limits for each. So this is actually a 4/15 tax deadline. So just also want to make you aware that you have time to make these contributions. 529 savings, always like to make sure that as you think about saving for college education, you're on track with your savings goals. Annual gifting limits to apply. It's $19,000 per person as you contribute to 529s, but certainly just want to take advantage of continuing to save within the 529. The other thing to take note of is that here in Illinois, for example, we have an Illinois state tax deduction based on the contributions you make. So certainly something state by state to evaluate if there's an opportunity for that tax savings.
I'll hit on inherited IRAs.
Okay.
As we think about the deadline here of 12/31, this is something we've been talking about quite a bit. And the rules prior to 2025 was that there was no penalty for not taking the required minimum distribution out of inherited IRAs. Now, keep in mind this applies to folks who inherited money from a loved one after 2020 or in 2020 and beyond, where the rules have also changed where you have to take that money out within 10-year period. So this is very important. Obviously, if you have one on our system, we are tracking that on your behalf and helping you fulfill that required minimum distribution and building strategies around that. But obviously, you want to avoid those penalties. So make sure you're proactive there as well.
Yeah. Well, and then the last item here on the list is just thinking about annual gifting. Certainly, if you are doing any annual gifts, maybe you're writing a check to a child around the holidays, you want to ensure that gets cashed before the end of the year, just to make sure that that gift counts for 2025, and then you won't exceed the annual exclusion amount if you decide to do that gift again next year.
Yeah, so these are just some of the key numbers, where we like to focus is being proactive and thinking about, with year-end planning, having awareness. Let's talk about some strategies even to consider. I always like to keep in mind these are just ideas. This is not any recommendation to put in place today. That's where we can work one-on-one to decide what's going to be the best fit for you.
So Roth conversions are always a core focus as we head into the end of the year, as we have more information on your dividends, capital gain distribution, even capital gains. Those are things that we're looking at to see if you have capacity in your current tax bracket or potentially in a reduced but higher tax bracket to really convert assets at a lower dollar amount. Again, Roth conversions don't necessarily make sense for everyone, and that's something that we're happy to provide feedback on. If there's not a case to do Roth conversions, really why, when you reflect on your individual tax situation.
There's a few red flags you want to be mindful of, especially not just a higher tax bracket, but pushing you into a higher tax bracket, but also just be mindful of potential spike in income, which could impact Medicare premiums, or especially with the One Big Beautiful Bill, which will highlight some pieces here in a moment, just to phase out on either some state and local income tax deductions, or even, thinking about the additional enhanced senior deduction as well. So just be mindful of that. There's impacts to each of these pieces, and just want to understand, the trade-offs of that.
Definitely.
So as we think about proactive tax planning, this ties to especially Roth conversions that we were just talking about. Understanding base case of where you're at today can really shed light into observations around looming tax liability that you might have coming up in April of the following year. Start to think about if you're making quarterly estimated payments, just to make sure you're shoring up that January 15th payment. But then also, understanding, again, going back to the Roth conversions, where I stand from a tax bracket standpoint, because if you can fill up, the current tax bracket that you're in, and not push you over a limit and convert a little dollar amount at that point, that could be beneficial as well. So itemized deduction is the big one as well. As we start to think about the One Big Beautiful Bill, there's been a change in the state and local income taxes by pushing that up to $40,000 if you're under a certain income threshold. Otherwise, you're reverted back to the $10,000 limit. But also starting to understand where your medical expenses are tracking. Are you in a position where you can start to deduct those? Are you looking at your charitable deductions or charitable contributions, and are you getting the deduction for those or not? So understanding, where you're tracking for your itemized deductions, if you're going to be over that threshold of itemizing versus not, is extremely important, because if you're close, that might make sense to accelerate some of these items to put yourself in a better position from a tax deductibility standpoint.
With the One Big Beautiful Bill, there was a thought that there would need to be a push for a lot of estate planning. The limit was held steady for a federal estate limit at 13.99 for 2025. So just as you think about, is there anything from an estate planning perspective that you need to do? There's no immediate changes to that. So just keep that in mind. That's not an urgent priority, especially heading into year end.
And then we talked about the One Big Beautiful Bill quite a bit here already, but this is also bringing back a slide from what we talked about in our last video, where Carrie and myself, we highlighted some of those major changes. So we're not going to go into much depth here today on that, so we recommend you checking out that video from last month. But this also ties to that awareness and that proactive planning, because as we think about those Roth conversions or where your income's trending, that could impact your enhanced senior deduction. Charitable giving, this is a critical year to be looking at that, especially if you're charitably inclined, because next year in 2026 is when it starts that you're capped on your deductions at 35% versus this year, 37%. Plus, it introduces a 0.5% AGI floor, which basically means that based on your adjusted gross income, there's a limit of where your deductions can start, beyond that 0.5%. And then we just touched on the increased SALT deduction going up to $40,000. But it starts to get phased out if you're making north of $500,000 per year. So these are all things that, again, we're having conversations around, but I would say this year is a little bit more important because there's some changes in the 2026 that are definitely going to be different than what we're seeing here in 2025. Okay.
Yeah. Anything
else to add here, Molly?
No, lots of exciting things to look at. Lots of meetings already so far. So just it's fun getting to talk to everyone and kind of finalize some priorities before year end.
Yeah, that does conclude our topic here today. And as we think about the final couple months here this year, if you haven't provided your tax return at this point, definitely send it in. It's a big part of this process. And if you're not on the calendar yet, you will be here shortly. And we'll look forward to seeing you soon. Thanks so much.